deals can just die just because the information flow stops. A lot of times these lists will come over, they're going to use terminology that's different than the business owner may be familiar with, and there needs to be an interpretation of what it is. Somebody who's been through it, knows your industry, can really pare that thing down very, very quickly because they know what they're looking at and they've got their skill set.
Good afternoon. Welcome to the Deal Factory, powered by 3PG Advisors. I'm super excited today to have Gloria Palmer in studio with us. Hey, Gloria, good to see you.
Good to see you, Jeff.
For those of you that may know Gloria, she's been a longtime leader here at 3PG as an executive advisor, and a lot of exciting news in our world. We recently started a new business unit called Source Expert Advisors together. Gloria is a co-founder and president of that business unit, Source Expert Advisors. She's also, by the way, one of the best CPAs I've ever been around, and I know that that's a broad title. But we're going to have some fun kind of getting into exploring some different buy-side concepts today. So again, excited to have you in studio. We don't get to do this much, just sit in studio and talk shop. So we'll definitely have some fun today in doing that. So for the audience, what I want to do is let's just start with your background and story. You and I met many years ago, fortunately, through a headhunter and through some transition that you and your family were going through, relocating to Georgia from Chicago, Illinois, that neck of the woods. But talk to us a little bit about, just tell your story and your background, because it's very unique. And for us, it's been kind of a competitive advantage together in the business. So jump in here and walk us through kind of your story and background.
Well, thank you, Jeff. With my background, sometimes I say it didn't all start making sense until I did start working on deals with entrepreneurs. My career kind of started in my childhood. I grew up with a family business in the house, growing up with service calls coming in, and later on an office in the back. And periodically through my childhood was also helping out, answering calls and doing various office work. And so it was instilled in me at an early age just exactly what that experience of being a business owner and being in a small business was.
Yeah, a family business, right? Mom, dad, brothers, like the whole family.
Yep. So,
and you guys were in the trash compaction or compactor industry, is that right?
Yeah, garbage compactors, recycling equipment, balers, installation, service sales. Yep. And that's taken you a long way, right? Because you can just relate to some of the I say this in a nice way. There is family drama that goes along in business, and certainly it's not easy. So fantastic. So started in the family business, growing up, got a front row seat to success, failures, systems, et cetera. Where did you go from there once you got into school, and talk us through that part? Yeah. So I went to school and I studied business. Didn't know exactly what I wanted to go into, but actually did not enjoy my accounting classes at all.
Really?
When I was in school.
Yep.
Yes. Part of it, and there's people who agree with me, it's the way sometimes accounting is taught in school. Mm-hmm. But when I graduated and hit the working world, the first real full-time position I had was with a large bank, and I went through their management training program. Okay. So this is a program lots of large companies would have where they would take in college graduates and bring them through a rotation of duties to kind of orient them to the company and find where they might best fit. So we were in Indianapolis area at the time, and I ended up as the office operations manager for a banking center near Indianapolis.
Right.
And that was essentially you're in charge of all of the day-to-day operations of the banking center, second in command under the banking center manager. And then 9/11 happened. And a time after that, my husband joined the military.
Yep.
And I temporarily moved back to the Chicagoland area to be near my family. And in this transition, I actually was able to go into the corporate office of this bank in the Chicagoland area and led a team of people who were former people who worked in banking centers, but now we're in this new group supporting banking centers. It was a help desk or an operations desk of a sort where we would troubleshoot problems that the banking centers would have, solve things, roll out initiatives, anything that really needed to be a liaison between the corporate down to the banking centers we handled.
So a lot of process, a lot of SOP, problem solving.
Right. Lots of problems.
Right. Now, was this after the audit? Weren't you involved in the banks were getting audited under Sarbanes-Oxley and
you've
somebody
heard me
said,
say this a few times. Yeah.
Tell that part of the story.
Things started happening that were a little odd. Like one day we got to work and we had lost access to all of our systems that we needed to support the banking centers.
Yeah, that's panic morning.
Yeah, and then we had to basically support why we at the corporate offices needed access to the systems that went into people's bank accounts and the ones and the systems that the people in the actual banking centers had access to. There were different, I'm going to use the term audits. They were these different, just odd audits that were coming that because we facilitated between corporate and banking centers, we were used to help complete. And at the time, I didn't quite understand what was going on. But then I knew, this was the rollout of the Sarbanes-Oxley or SOX legislation because this bank was publicly traded. Yep. And it was the first rollout of that. So this was really my first experience. We had audit procedures in the banking center because you're dealing with money and vaults and all of that. But this was really my first experience doing audit in a way where kind of like an accountant would do it. And it was really internal controls based because this is all the legislation that came out of the Enron scandal and all of that.
Yeah.
So
fast forward, somebody says to you, hey, Gloria, like you're really good at this audit stuff. Like, did somebody plant a seed on public accounting? How did you pivot from family business, front row seat there, mom, dad, your brothers, you get into banking, kind of that first professional job. You remember those days we're all young and not really knowing where we want to go with our lives, and you're exposed to so many different things. Boom, here comes Sarbanes-Oxley, all of the audit process. Somebody says, hey, you're really good at this. Did somebody say, hey, you're really good at this? Have you ever thought about getting into public accounting and being an auditor? Or how did the pivot happen from banking to get into that world of accounting and public accounting?
Yeah. Well, the pivot really happened when my family was moving near Fort Meade, Maryland from the Chicagoland, or where I was in the Chicagoland area.
Yep.
So I was going to have to find another job. And I was networking and getting recommendations from the people I was working with. And it was really looking into banking or perhaps a position with the Fed. One of the people I work with had a connection there. Or there were accountants who were working on these audit projects. The recommendation is maybe you do want to look into public accounting because you do seem to have a knack for this work. And I joked I was the only one who actually enjoyed helping them versus other people.
But you didn't like accounting classes growing up, by the way, right?
No,
so
I
it's
didn't
really
like
interesting.
That. Yeah.
So fast forward then, you land in an accounting position, right, at a public accounting firm.
Yep.
Talk to us about just that time with some of the things you had your nose in as you were learning that trades.
Yeah. Well, I mean, you join public accounting, it's the same story. You get your laptop the first day and the second day you're out at a client. So my first
In a closet? Did you like work in a small closet at the client?
I think it was a small office.
Yeah.
We were doing at the time I was immediately put on SOX work,
Yep.
which is a little less confrontational than when you're doing their financial statement audit. But I did that work. I got staffed on some internal, we were supplementing an internal audit function of a large company. And then basically went through a rotation of a few different departments of the firm and ended up doing 2 tax seasons.
Okay.
And I ended up choosing.
That sounds miserable.
Well, that's.
I'm kidding.
That's
okay,
usually
for those
in public,
tax CPAs in the audience, I'm kidding. I know that there's a time and a place for taxes, but it's not my favorite part of the accounting world. It's not yours either.
Yeah. Usually you measure your time in public accounting on how many tax seasons you've been through.
There you go. There you go.
But did do a rotation through a few different industry groups and ended up selecting the construction industry services group. That's the one I felt the most comfortable in. I liked the people. These were general contractors, specialty contractors, and just the feel and vibe of companies like that is completely different than if you're going into like a real estate developer or anything else.
Sure.
So that was the industry I chose, and that's where I really honed my skills on all of the construction accounting.
Right,
So,
which is in that world, it's heavy work in progress, WIP, it's revenue recognition,
Yep.
it's it's a different world in the trades. We'll talk more about that here in a few minutes. So how many years in public accounting?
2.
in that? So 2 years there. And then maybe, did you move again, or what was the next pivot as you got into the next part of your career with being a CFO?
Yeah. So the next move was getting out of the military, and we moved back to the Chicagoland area. And I had the opportunity to work for an HVAC contractor in the Chicagoland area. And I spent about a decade there. And the fun time of that is I was hired in 2006, just before the crash. So it was an interesting decade. It was very challenging. And I would say through that time, definitely honed my skills on things related to cash management and cost accounting and really getting to the root of profitability and being outside Chicago, in Cook County, so many things having to do with compliance and labor. We were a union shop and
That's right. So
did
certified
projects
payroll,
and,
labor shop.
Yeah.
And then again, right, part of the trades industry, skilled trades, there are big egos there. There's dynamics with culture. And you were there for 10 years kind of navigating that whole world.
Mm-hmm. Yep.
Yeah.
Yep.
Fantastic. So let's make a pivot here. So one of the things that I've always admired about you and our work together is you have very unique background and experience. You've grown up in a family business. You've been in retail banking, commercial banking. You've been in public accounting as an auditor, specifically in that construction world, which is not just invoice-based, right? It's a little more complicated with retainage and earned revenue and work in progress and all those things. And then you've been a CFO and were there for 10 years and just the complexities of the day-to-day in a skilled trades, blue collar. Were you multi-branch or just one branch in that?
One.
So just one branch, right? And so one of the things that's been great in the time that we've spent together at 3PG, and we'll introduce kind of the deal side here in a minute, is you've seen so many different scenarios given your background and given your experience. And one of the things that you and I talk about a lot, particularly in both the sell side part of 3PG advisors and now with Source Expert advisors, spending a lot of time on the buy side working with private equity firms and investors. We've talked a lot about your ability to see things coming and problem solve. And I think, for anybody in the audience, there's this shortage in the world, in the professional ranks, in my opinion, on folks that can problem solve. It is a unique skill. So I'm going to put you on the spot. Like, is that just experience? We have plenty of talented people that we come across, both buy side, sell side, from the advisor world. But how does your brain work where you're able to start piecing together, hey, there's an issue coming, or piecing together, hey, we need to create a solution here? Is that just experience, or is it process? Is it the way that you think? I mean, I know I'm putting you on the spot, but kind of give me some insight to how you go about the problem solving aspect of your skill set.
Yeah. I mean, it's probably a combination of a lot of things. There is the experience of actually being in circumstances, and not just one perspective, have seen various different aspects of it, as we say, being able to see it through different points of view from the various positions I've held. Part of it too is I don't like memorizing a bunch of facts. I'm very conceptual. Mm-hmm. So I really, really seek to understand not just the facts of the problem, but really understand what's going on comprehensively. Yeah. And that helps you pivot and troubleshoot if you actually understand what's really going on behind the scenes, or, what are you really trying to accomplish? And I think the experience piece, that's just the real world. And maybe part of it too is going back to the small business. Yeah. When you're in small business, it's sometimes there's no one else there to do it. If you've only worked in large companies with, 8 layers of management, there's always somebody else who can do something. In small business, it's you or no one. You got to solve the problem. You got to figure it out. Yeah. So what, necessity's the mother of invention sometimes.
So do you think when you have accounting and finance professionals moving and navigating through their career, most start obviously in public, right? Like that's grained into your head in school, like this is the track you got to go. Was there an aha moment where even when you came to Atlanta, so when you and I met in Atlanta, you had never really spent any time in mergers and acquisitions or investment banking, right? You had your traditional background, and then kind of quickly, as you and I got up to speed in the early years of 3PG and we created a lot of momentum, there was a time it's just you and I just figuring stuff out, right? And we always kind of go back, and I think about that career track of debits and credits and month-end close and traditional accounting versus finance, right? Mm-hmm. So talk a little bit about, and again, I'll tie this into where we're going with the new business unit, and I'll tie it into kind of this buy-side approach. We have a lot of people that are in our audience that are making decisions on whether or not to do an acquisition, what it takes to navigate the buy side. But you and I debate a lot, and this even comes up with hiring in the org chart, the difference between the accounting concepts versus the finance, because I think the average business owner, particularly in the skilled trades world, they kind of get confused on what is finance versus what is accounting. And I end up making the wrong hire. I try to make my accountants finance people, or I try and make my finance people accountants. And again, I know that there's different approaches and different skill sets there. But if I were to ask you what makes a good accountant versus what makes somebody good in finance, can you articulate for me on that? And I know that's a little off script, but we talk about it all the time.
There's different kinds of accountants. And if you're talking about what makes a good accountant, what makes a good public accountant, somebody who's doing audit and doing financials in accordance with GAAP and things like that. That's really, I think the skill set is, and this is probably in all of them, attention to detail and being able to adhere to standards, being very, very high summary.
Yep.
Then if you're talking about working in a business, you need that additional skill sets of the managerial accounting and I think in the cost accounting pieces. And those are the pieces that really drive into, well, getting into the guts of what the business is doing and profitability at a job level, work order level. I'll use terminology having to do with contractors because that's what we're talking about. And that granular level isn't necessarily part of just carte blanche financial statement audit. Right. Those types of skills, you really, really need to understand how the business is moving and what it's doing to be able to produce that kind of information that actually helps a business owner run their business. Yeah. If you're talking going into finance aspects, some of this is a little bit more prospective looking and planning. And there might be some more estimation and risk management. And that a lot is more of the finance skills. Now, I don't want to do the black and white accountings looking backward, finances looking forwards. Yep. I don't think it's as simple as that. Yep. But it is a very different skill set if you have somebody who wants to follow the rules and get things exactly right versus, hey, let me creatively give you the information you need to run your business, to, hey, let's look to the future and see what kind of strategic things we can do and make some projections based on that so you can make forward-looking decisions.
Yeah, it's so interesting you say that because providing business owners and entrepreneurs the right data and tools to make decisions, a lot of times that's not black and white. It's not debits and credits. It's not month-end close. It's not sales tax and income tax. It's forecasting. There's some creative elements to it. We see a lot of frustration over the years. You and I have seen frustration around, the lack of reporting. We often see once you bring in an investor or a private equity firm that, the business owner and their accounting and finance team is caught off guard on the demands of cash flow forecasts and budgeting and kind of, and you can't just do that by sitting in the office in a spreadsheet and making up numbers. You got to engage your management team. You got to gauge your owners, that sort of stuff. So yeah, it's really an interesting, and it comes into the org chart and the hiring, but there was a time in my career before you and I met that I just thought accounting was accounting. And then I got more gray hairs now, but as we've gotten more experienced in our businesses together, you and I, it's a little bit fascinating on personality profiles and job descriptions and duties of, I'm really looking for somebody that's got more of a finance skill set than what I would consider a controller or accounting type background. And I think a lot of business owners miss that fact. And so it's interesting to kind of see how you break that down. So, all right, so let's come back and I want to make a pivot here. Okay. I want to talk about how excited we are with the Source Expert Advisor business unit. And I'm going to kind of frame it up for the audience, and then you and I will dig into it. So we've had great success in our sell-side business. That's taking entrepreneurs that are ready to retire, ready to sell their business, ready to invite in a private equity firm. And we think we're best in class with that. And we've had a lot of success, and we've been continuing to grow our business there. What's been fascinating for you and I is really this evolution of private equity money coming into the skilled trades, the contractor world, the facility services world, any kind of buzzwords that we use. And so, and that deployment of capital continues to be at what I would consider a record pace. But one of the things that's interesting as we talk to different private equity groups, some that are having success winning deals, integrating deals, elevating and creating a significant amount of value. One of the things that I think is interesting is most of the investor community, or a large part of the investor community, is more traditionally trained, right? They've come up in the accounting or finance world, or they've been investment bankers. They haven't necessarily owned a business before. And owning a business is tough. Like, hey, tomorrow in my HVAC company or in my turf care company, there's going to be people that don't show up. How do I deal with that? And so you and I kind of chuckle a little bit when we're having lunch or talking offline that you and I are able to speak entrepreneur. Like, we can relate to the entrepreneurs. And in the source expert model, where we have the ability to work with private equity groups and connect with them, I think there's a gap there on being an investor and being able to relate to the entrepreneur. I want to dive specifically in on this concept where you and I feel like, or we're seeing, there's been a large amount of direct outreach from private equity and buy-side search firms calling the entrepreneurs, right? They're getting an email, they're getting a phone call every day. And then let's just say they get one on the hook. Hey, here's a business that we think we want to talk to and acquire. And maybe they get to a letter of intent, but suddenly either they can't get to a letter of intent, or more specifically, the entrepreneur, the business owner, the founder is just so underprepared of what it's going to take to move through the 3 due diligence work streams of business, legal, accounting, right? Those areas, and deals die on the vine. Or we use the term deal fatigue, right? Something happens. So you and I have talked a lot about a Navigator concept where in our business model at Source, we're able to help guide the entrepreneur that's never done this before and work through how you get to the closing table, overcoming all the due diligence, right, that's going to be thrown at them. And let's be honest, half of it they don't even understand. We've had groups that, hey, I'm not really sure what multiples on invested capital are, or what is EBITDA. So I want to talk about the Navigator concept, but the best way to talk about Navigator is not a pitch. Like, let's walk through some of these issues that we've signed a letter of intent. The seller is now getting ready to jump into due diligence, and they have no idea what's coming. So let's talk a little bit about the complexities, the frustration, and the things in the deal and accounting world that people have trouble overcoming. So jump in here and just talk about concepts around fixed assets and working capital and WIP and just those things above and beyond just, hey, you just got 250 items that you have to pull, right? So jump in here and talk a little bit about navigating that due diligence world, because you just signed an LOI. And by the way, I'm just the owner of an HVAC company, and I don't know what the heck I'm doing. I'm hopefully relying on some advisors. But what are the big pitfalls that we see there?
One of the things that we see, and this is rightly so for other reasons, is it's a very small group of people who will be working on the seller side. It might just be the owner themselves, or they may bring in 1 or 2 of their trusted people. But remember, these people are already running a business. They've already got
full-time job.
6 full-time jobs.
That's right. If
they're running a small business. And trying to navigate through a transaction is another full-time job. So there's that aspect to begin with. And second, exactly what you're talking about, the information requests that will come in are very voluminous. And we've worked with lots of different groups, and some groups have it consolidated down and it's neat and organized. Some of it, it's 12 lists and there's a whole bunch of duplicates. I mean, it's all the gamut of what it is. And just having the skill set, which not everybody has, but really to sit down with that volume of requests and organize through it, answer it, process it, and get it over to the other side in a way that they can consume it and it facilitates the deal and you can move forward. I mean, it's an entirely different skill set. I mean, I was able to draw on my audit background to do that, but not everybody has that background. And if you think about just being stuck with all of that, deals can just die just because the information flow stops. A lot of times these lists will come over, as you said, they're going to use terminology that's different than the business owner may be familiar with. And there needs to be an interpretation of what it is. Or maybe you got a list that is a canned list that's supposed to deal with just about any industry group, and you're not sure, well, which are the ones that I know are just not applicable to me. Something like that. Somebody who's been through it, knows your industry, can really, at the onset, pare that thing down very, very quickly, just because they know better what they're looking at and they've got their skill set. So that's kind of the number one. If you're talking about things with the questions that can really stall things, as you said, financials, you referred to a lot of financial concepts. The investor world is going to look at the financials in the way the investor world looks at all financials. And that's going to be based on generally accepted accounting principles. Right. Okay. Now, as I kind of alluded to before, that might not necessarily be the way that owner's been running their business. Okay.
Yeah, typically not, right?
Yeah. And honestly, GAAP accounting, it's made for investors. The whole point is to put all the businesses on the same standard so an investor knows, should they invest in company A, B, or C if everything's on the same? It's not developed necessarily to help somebody actually run their internal business. That's the different kinds of accounting we talked about. Right. So unless this business owner has already, and it's usually a third party such as their bank, has demanded that you need to start giving us the version of your financials that are, perhaps compiled, reviewed, or audited, they might not have seen that. Or maybe they haven't hired somebody who keeps their books to that standard. Yep. So if they're not already used to concepts that essentially take kind of more cash basis financials, but match revenues and expenses together more on an accrual basis, the financials that they've been looking at all along, that of course they're managing their business based on cash, they have to survive. Yeah. And they may have some managerial and cost reporting that they're using, or KPIs or things like that, to make decisions with the business day to day. They might not know really what their financials look like if you put them to essentially a GAAP standard and then do an adjusted EBITDA calculation on them. Yeah,
and it just it makes it so frustrating because, and we hear this a lot. We haven't experienced this because I think we have good process and good team members in our sell side business, but you hear the terms all the time, retrading, right? The deal trades, or I thought my EBITDA was 1.5 million and it's really 1.2 because of a work in progress or revenue recognition issue. And it's interesting, oftentimes, they have a tax CPA. The client, the seller, the entrepreneur has a tax CPA that's doing their tax returns, but maybe really not in the day-to-day of financials and bookkeeping. It's interesting you say, I can't remember the last time we saw audited statements. And we're working with companies doing between 1 and 10 million in EBITDA. Yeah. We don't see a lot of audited or reviewed statements. We probably see more reviewed certainly than audit, but we see a lot of internal, right? And then a corporate tax return. So it's really interesting that I think the investor, given their sophistication and if I'm a private equity investor and I have all of my advisors and groups around them, everything kind of comes back to GAAP compliance, right? That investor standard, as you put it. But the reality of it is the average entrepreneur is a little bit lost. They don't even know what GAAP means sometimes. And I say that respectfully. So, this Navigator concept, that we've seen is somebody that is a quarterback and a guide to be able to walk somebody through all the heavy lifting that's coming. And listen, deal fatigue is real, and so is retrading. There's nothing more frustrating for an investor to spend a bunch of money on due diligence. And by the way, there's a legal issue, there's an accounting issue with EBITDA, and now everybody's backtracking and everybody's mad that we can't get to the closing table. So really interesting there from a concept perspective. I think, Gloria, that the balance sheet is the most misunderstood financial report for the average entrepreneur. And I wanted to talk a little bit and maybe even geek out a little bit on some of the balance sheet items that probably the investor takes for granted, but the entrepreneur misses. So can you talk about a little more on revenue recognition and WIP? Can you talk about how we don't see a lot of proper accruals and how the accruals come into play? Can you talk about mismanagement of inventory? Like, these are all real world, items that we see in a skilled trades business in the facility services world, where it leads to the end of the day not getting a deal done or a change in the deal metrics or whatever. So let's geek out on the balance sheet a little bit. And I have in my head starting with cash, right? You've trained me well. But just talk about those pitfalls on the balance sheet that if you don't have them in order, it's going to negatively affect EBITDA. Because I've always said if your balance sheet's wrong, okay, so is your P&L. So, talk about those pitfalls, talk about those diligence items that are going to come up in Q of E, and then everybody's mad.
I mean, essentially, the balance sheet is the bridge between the changes in cash and what's on your P&L. I mean, if you're doing cash basis financials, your P&L basically is your cash, your changes in cash.
Well, what is cash? Explain cash. Like, I recognize when. Like, walk me through 2 seconds.
Cash is essentially cash. So
when I receive a check or I write a check, basically, it hits my statement. Is that a good layman's way to describe cash basis?
Yeah.
Okay, so if I write a check or put a check in the bank, that's when I recognize revenue expense.
Yeah, if you're talking cash basis accounting,
Yep.
So that is basically, you're looking at your bank statement, everything's going out, everything's going in.
There's money in the account.
Yeah, there's money in the
winning.
account. Well, that's how you got to survive sometimes.
Yeah.
So anyway, that's really cash basis. But then you run into, you'll talk about, you keep saying revenue recognition and WIP. Okay, well, if I'm going to do a job and to preserve my cash, I want to take a down payment from a customer. Okay.
A job deposit.
Yeah, a job deposit. I'm going to take a down payment from a customer and I'm going to put that in the bank. So my cash goes up, but have I really performed that work yet? So can I really say, hey, I was really profitable today. I got this deposit. Well, no, not necessarily. If you have to buy material and you have to pay people to do that work. So essentially, what would happen on a balance sheet is you'd kind of take that deposit and it goes in your bank, but I'm not going to show it as revenue or profit yet. I'm going to park it on my balance sheet. And then essentially when I can match it with me performing the work, paying the people, buying the materials, then it would flow through onto my profit and loss statement together. And then that would be a good measure of the actual profitability on my profit and loss statement. Now, that's a very simple way of looking at it, but that is the example. So when you've referred to WIP, work in process, think of many jobs, many things going on where the performance of work may be happening at a different pace then the actual invoicing is happening.
Yeah.
Because I'm invoicing probably to maintain my cash position,
Right.
and I'm invoicing, it might be because of some compliance issues in a contract. It may not match the realities of how I'm actually performing the project, and how, if I were to say, how much of this have I actually earned? So that phrase is really just that difference between what can I say I've actually earned and what have I actually invoiced.
Yeah, I agree. The concept of have you earned it yet?
Yeah.
And what we see is a lot of folks don't think about have I earned it yet? It's did I put cash in the bank?
Yep.
Or did I invoice? Or did I put a bill in? Right?
Yeah.
And so that can create really a lot of miscalculations around revenue and profitability, and thus EBITDA. And guess what? We're back to the table, and your business isn't worth $10 million. It's only worth $8 million.
Yeah. Yeah.
Talk to me about, and I'm using real world examples, and there's some frustration here. Talk to me about fixed assets, particularly how you and I get a fixed asset schedule from the CPA. We get a fixed asset schedule that comes from the insurance side of the business. We get an operational fixed asset schedule, and at the end of the day, none of them match. Surprise! Talk to me about how an entrepreneur or business owner should demand from their team, including their CPA, that things tie in that fixed asset world, right? Because it comes into play with CapEx, it comes into play with depreciation. So, walk me through fixed assets on where people are failing all the time.
Yeah. Fixed assets are important to these companies we're working with because they directly generate EBITDA. If you're talking about contractors.
Right.
So there's lots of machinery and equipment and tools that go into the generation of that revenue. If you're talking about an investor coming in and seeing it, if there isn't an accurate list of what they're actually using and not good records of what they're purchasing, it's hard for that investor to really get a feel for the cash outlays that have to happen to generate the EBITDA of what's there. Some of the pitfalls for that are just there's no good records, so there's not good information that they have. The other thing is if good records aren't happening, you could actually have lower earnings or higher, but it's usually lower earnings than you would have otherwise had because maybe there's items that could be put on your balance sheet, meaning these are large items that have many years of useful life, but you're expensing them. But you're expensing them. Yeah. And you're expensing them as expenses, not putting them on your balance sheet and depreciating them. So those are two ways that if there aren't good records that could negatively affect a business owner.
Yeah. So if I'm a seller, get ready because the investor world, private equity, private investors, they're going to come back and say, what's the cash flow impact to when and how much trucks and equipment you're going to buy, right? Because that becomes a factor in the deal, capital expenditures. And it's so interesting to you and I how we don't see good work papers, we don't see good records, and the average entrepreneur and business owner doesn't even think about, hey, I bought this truck because it's replacing a truck that's worn out versus I've bought this truck because I just sold $1 million of new contracts versus, and we see this, I'm buying this truck even though I don't need it for replacement or growth, but I don't want to pay another penny to Uncle Sam. I'm going to buy this truck.
And I just want a truck.
I just want a truck, right? I'm a gearhead. I just want a truck, or I know I'm going to need a truck 6 months from now, but I'm not going to work. And so it's so critical. And again, going back to just this Navigator concept, the average entrepreneur just knows what? I turn that stuff over to my CPA and they produce a depreciation schedule and I'm done.
Yeah.
Right?
But this is the type of thing you have people ask you all the time, what's my multiple? And I'm introducing a new concept here. But if you've got two businesses, same earnings, same cash flow, one can manage it with provable less capital expenditure year over year. That's a more valuable company.
Right.
So those records are very important if you're looking to value your business.
Yeah, well said. Well said. Okay, so I want to stay on the balance sheet, and I want to get into arguably what's the most frustrating part of a deal, not only for us as advisors, but private equity investors and the entrepreneur, and that is working capital.
Yes.
And man, it stinks. I wish we had a magic bullet, right, that we could use just to be able to work through working capital. And by the way, we do a good job of doing that. So I want to just take a minute and coach the audience on the importance of proper accruals, because we never see them. And I want you to walk through like 4 or 5 accrual examples, okay? And then I want you to say, here's how it impacts the calculation of a working capital peg or requirement, okay? Now, before you do that, I'm going to define working capital from a non-accounting and finance perspective. I'm going to put on my entrepreneur, my business owner hat. So we always like to describe it as this, and this is very layman. If you're going to acquire a business as a buyer, the expectation is you're going to have some cash flow still happening in the business, coming in the door, inflow and outflow around the first 30 to 45 days post-close of a deal. The analogy that you and I use is we go down to the car dealership today and buy a big new truck. Our expectation is we drive off the car lot and there's gas in the tank, right? We don't have to pay for gas. And so working capital is really that concept of, for the first 30 to 45 days, is there going to be cash coming in the door? We know there's going to be expenses going out with rent and insurance and payroll. But it's a very frustrating concept when you now begin to pull in an accounting definition of less cash, current assets, current liabilities. So I want to focus on accruals, because I would say 9 out of 10 organizations, they're not doing proper accruals. And I want to see if you could walk through 4 or 5 of them.
Yeah. So kind of going back to our talk about the difference between cash basis accounting and accrual accounting, accruals will seek to record expenses or liabilities before the cash goes out. And then I'm just going to say, and its pair is the concept of the prepaid, which is the cash has gone out before I've essentially used it.
Yep.
So it's just, all of these concepts are the difference between essentially something's happened, but it shouldn't go through to the profit and loss statement yet. So if you're talking about the accrual side, things that happen before the cash go out, payroll. I mean, most people don't pay every single day. So there's accruals for that.
Wouldn't you say most companies recognize payroll expense not by counting days, but they just match it to when they run a payroll? So it's a cash basis type of concept.
Yeah, most of the companies we work with, they record their payroll on a cash basis.
Right. So there should be a proper accrual for payroll cutoffs. Is that fair?
If you're making an accrual, what you're trying to do is work that's been done in a month that hasn't yet been paid in that month. That would be the accrual. And if you're doing that every month, then the expense you're seeing is related to all the work performed in that month, not just what was paid in that month.
Yep. So proper payroll accruals is one. We see a lot of misses there, right?
Yeah.
It adds a couple more days or a week of expense, or it, we miss an opportunity to recognize some revenue, right, against some of that. What about bonuses, PTO, commissions? Like, what's the proper way to really handle that if I'm the entrepreneur?
Yeah. If it's been earned by somebody and it's a liability to you during a certain period, that's when you want to recognize the expense. And if you haven't paid for it in cash, then the balance should be accrued on your balance sheet.
So give me an example. So I'm a sales guy and I get a monthly commission, and let's say it's paid quarterly. And you're the business owner and I'm the salesperson, and I'm saying, "Hey, Gloria, I got this sales commission that I've earned at the end of Q3, and it's $30,000. How should that $30,000 really be handled?"
Really, if you're talking about monthly financials, the portion that this person has earned every month, if it's not going to be paid out, you would be expensing it and doing an accrual for it. So you would be recognizing that expense as it happened and accruing it on your balance sheet.
So instead of seeing a $30,000 commission payment on October 1, I would likely see three $10,000 expenses on my P&L for the quarter. Is that a simple way to look at that?
Yes.
Okay.
Yes.
And what about this concept of PTO? Because I guess bonus would work the same way as commission in that example, right? So what about PTO? And explain to the audience, use it or lose it, or explain to the audience, hey, this has been earned but not paid from a PTO perspective, and kind of how we would accrue that.
In a deal scenario, many buyers will not assume a PTO liability, meaning time off people have earned that they haven't used yet, that they're entitled to.
Right.
And we see different ways that this goes down in a real world. But if you're talking about being able to recognize everything correctly on a financial statement and show that liability, really it would be, usually you're doing it month-end calculation of what's the difference between what people have earned and what they've used, having that as a balance sheet liability. And the change in that liability month over month is what would be recognized on your profit and loss statement. Again, it's still just trying to get all of the expenses matched in the month that they're incurred. And if there is a difference between what's been incurred and what's actually happened in cash, the difference is the accrual.
Yep.
Now, swinging to why this is important for working capital is because what do liabilities do? And you're talking about working capital. In a deal scenario, it's usually cash-free, debt-free net working capital. So that means I'm not going to include cash. And if I have anything that per GAAP is debt, that's going to be taken out too. So usually people are pretty good about accounts receivable, work I've done that I've invoiced, I haven't collected the cash yet, that's in there. And payables, I put my bills in, but I haven't paid them yet, they're in there. Then there's the concept, as you talked about, sometimes they'll forget about the accruals or they haven't had a need to do it, so they're not on there. But what's important about this is if you don't have that history of those liabilities on your balance sheet, that means that when somebody calculates your cash-free, debt-free net working capital, it's actually going to be a lot higher than what it really is. Because if you're just taking receivables less payables, that's a higher number than receivables less payables, less your payroll accrual, less your sales tax accrual,
Exactly.
less all those accruals. And I know it sounds counterintuitive, but you actually want to make sure you're claiming all of those liabilities in your working capital because, as you said, they're looking for the first tank of gas. How are they going to measure the first tank of gas?
Right.
Usually it's based on historical calculations. And you could be inflating how big your first tank of gas needs to be if you haven't been claiming those liabilities.
Yeah. And so if I'm a seller under that scenario, I've left too much money in the business for the buyer, right?
Yeah.
I've left too much money in.
Or
flip
they'll
side
double
is-
dip.
Yeah, or-
and they'll call it debt
Yeah,
too.
that's a whole nother, we could go 15 minutes on indebtedness, right? So yeah, it's so important, and it's very complex around, the balance sheet and these working capital concepts. And it gets really frustrating, particularly with the reconciliation. And so I know we as an organization spend so much time educating our client, our sellers on the front end, so much time negotiating a working capital peg, including proper assets, proper liabilities from a GAAP perspective, and then so much time reconciling that 90 days post-close. And, if I'm a private equity investor, certainly they have folks around that know that, but we haven't found that they've been great communicators of what's coming, to the business owner or to the seller. And then it just creates a lot of false post-close expectations where everybody's pissed. Excuse my French, right? It's like, wait a minute, what do you mean you're going to take an additional deduction? Or, this wasn't explained properly. But I would also say to the average seller out there, there is a different approach around how educated are you and what is the gamesmanship to negotiating working capital. And at the end of the day, it could drive hundreds of thousands, if not $1 million difference in a deal.
Oh, absolutely.
And so again, not to geek out on too much in working capital. So listen, I know we're coming up on time here, so I wanted to thank you for being in studio, us geeking out and talking numbers. For the audience, we're going to continue at other times to spend more time with Gloria as we get into some concepts around being a buyer and being an investor, and also digging in a little bit more, because I think the average business owner and entrepreneur, including folks around them in the office, there's a lot of complexities to the accounting, finance, quality of earnings world. And I've always felt like you've done a masterful job of being a great coach and translator on, hey, here's why it's important, whether you're a buyer or seller. And then eyes wide open, here's what's coming, get ready. Because sometimes going through due diligence is like getting a root canal or a proctology exam. It's just no fun. Mm-hmm. And if you can't navigate and get through that as both a buyer and seller, you just don't close enough deals. And to some degree, you can spend a lot of money when you shouldn't be spending that money. And also, you can get in a position where you're just creating a lot of ill will and even a reputation of, hey, they haven't been able to close deals if they're a buyer, or hey, they're going to retrade you. And by the way, we've heard that. I know no buyer wants to be known for that, or no investor, but some of that is you have to retrade because you didn't know what you were getting into and the seller was so unprepared. So I know we can spend another hour. Wanted to thank you again for being in, and look forward to our next session with the audience. Take care, everybody.